But we are going to kick it off with oil and energy. Crude oil, maybe some good news for you drivers, back below $70 a barrel. Now, there really are a couple of reasons why. Number one, you got the IEA trimming its demand growth forecast for the third month in a row, thanks mostly to the slowdown in China. OPEC kind of with the same. Remember, they still see growth, but just slower growth. More importantly, new reports overnight that Israel is willing to not strike Iranian oil or nuclear targets. Instead, Israel may hit purely military targets. Now, those reports calming concerns of a major supply shock, which had moved oil higher. Obviously, fluid situation. Many things can change. Let's dig into all of it. Joining us now is AEI's Derek Scissors. He'll join us in a moment on the China part of the story. But RBC Capital's Helima Croft and Again Capital's John Kilduff are both here to chat about oil. Helima, I'm going to go with you first because we were both in D.C. last week. I know some of the folks that you were speaking with, some calming with these reports overnight about maybe, Israel won't hit back on Iran directly on the oil and energy side. I'm just surprised that the market appears to be taking all the risk off the table.
Right. The complete evaporation of geopolitical risk with regard to this conflict has come out of the market. So the question is this decision by Israel to not strike Iranian oil facilities, is that something that's going to hold? If it is the case, will Iran essentially stand down? Is this going to be an Israeli strike like we saw in April, a very targeted strike? Last time it was the Isfahan air facility. Is it going to be something like that? Or are we going to see a serious Israeli strike on Iranian military sites? Will that potentially create an escalatory spiral? Remember, Brian, Iran has already warned countries in the region that if it provides any assistance for an Israeli strike on Iran, they could be targeted. So the question is the Israeli action going to lead to an off-ramp or escalation? Yeah. I think it's too soon to say.
That's it. And Citigroup had a note out this morning, John, I don't know if you saw it, where basically they said our base case is Brent at 60. There's just a lot of oil in the world. China's slowing. But they also have a worst case, this is Citigroup, a worst case scenario of 120 on Brent if things were to, big if, I get it. Talk to us about where oil stands fundamentally versus geopolitically.
Well, I think you can't exclude completely the geopolitical risk factor.
No way, zero, right?
Right, no, but I will say, looking at what Iran has tried to do over the past year now, to me, their military prowess and or their mettle or stomach to do something significant just is completely lacking. So I have a hard time anymore pricing in much in the way of a geopolitical risk premium as it relates to Iran. If I were any of Iran's neighbors, I wouldn't be one bit afraid of any kind of retaliation from them. Fundamentally, though, Brian, look, when you have the United States position continuing to be what it is, number one oil producer, major exporter of crude, recent ramp up in gasoline exports to the rest of the world, the LNG exports that we're doing, the Guyana reservoir,
Brazil maybe going to 4+ million by next year. Libya
finally figuring out that it's really not in their interest not to sell their oil to the global market and play along necessarily completely with the OPEC plus quotas. There's supply abounding out there, and you have China also as well. I know you're having a guest come on and talk about that, but China is also sitting on this Middle East situation, telling the players involved, don't disrupt our oil supply and wreck our economy with prices that could go easily.
John, quickly, fair to say, you could make a pretty, I think, salient argument for $50 oil, right?
No doubt about it.
Just supply demand taking the risk off the table.
Especially if the Saudis do follow through on adding more oil to the market.
So Helima, I'll go back to you, obviously, on that, because I know who you talk to, and it's the highest levels. Okay, we'll leave it there. And we'll say this, which is, we always talk about the Fed put in the stock market, the sort of the idea the Fed's got your back, they could cut rates, do some stuff. Is there a Saudi put? Because if something were to happen to Iran, the Saudis, I think, very quickly could fill that hole in the global markets.
Well, first of all, I would say that the White House was sufficiently concerned about Iranian retaliation and escalatory spiral that they really have worked very hard to get Israel to walk back its potential target list. So I do think they're taking seriously in Washington the potential that Iran could escalate. And we certainly saw in 2019 that Iran did have the capacity to hit regional energy infrastructure and quite significant regional targets. But if we think about potentially, some type of blow up or de-escalation, the question will be, what will OPEC do? And I do think the Saudis will be in a very sort of cautious mode about bringing barrels back if there is some type of escalation. They'll want to see that there's a physical supply disruption before they really jump in front of this. And they also have an OPEC deal that extends through 2025. I don't think they want to break that up. But the question that John was bringing up about what the Saudis are going to do in December, that will really hinge on what happens with Iraqi production, Kazakhstan production, whether they comply with the terms to compensate for overproduction. That will dictate the pace with which Saudi Arabia brings back their voluntary cut of 1 million barrels, not the collective cut that extends through 2025.